Hello, Brian Beaulieu, ITR Economics, and thank you for joining me for this edition of FedWatch. Today is August 24th, 2023. Really, two things have occurred, and I just want to touch base on both of those. I'm going to start with Fitch, downgrading the U.S. debt to AA plus from AAA. It's not enough to move the markets. We've seen the markets just generally shrug it off in terms of the stock market. Long bond has gone up about 10 basis points, a little bit more. Not a significant move. Fitch does really good work in terms of their analysis, and we agree with their analysis, by the way. The economists who are poo-pooing the downgrade are looking at the employment data, what's going on right now in this business cycle. And if you read what the analysts had to say from Fitch, we wholeheartedly agree. It's about a lack of fiscal discipline. It's about gamesmanship when it comes to the debt ceiling. It's about not having a clear plan for dealing with our increasing debt over the intermediate term, all of which is spot on as we are concerned from our perspective, and it's consistent with what we see for the 2030s. So kudos to Fitch. Doesn't change anything because, as I said, it doesn't really move the market, but just give them a nod. The other thing is I went through and I listened to Chairman Powell's speech following their decision to raise interest rates in July, which was not a surprise. And I noticed a difference in tone and tenor in that he acknowledged right up front that the full extent of monetary policy has not yet been felt. And not once did he mention that there was a strong majority for another rate increase. In fact, the bottom line was, after he went through all the economic data, was that the CPI came in more favorable than they anticipated for June. The tightening of credit conditions is continuing, and that's going to be its own drag on the economy. And that labor demand is indeed slowing, but it's not yet in balance, but he acknowledged that it is slowing. He acknowledged retail sales is slowing. And instead of warning us that another increase is likely in either September or November, he said, there's a possibility we will rise. There's a possibility, his words, that we'll hold steady. And that's a change from last time. And that's because that data is beginning to move. We're going to have two more employment numbers come out in 2 more months of that data, 2 more CPR reports come out, and we'll have to see. And the other subtle change that I heard him say was, rather than being adamant about that 2%, but he said it ad nauseum, the 2.0%, but he also added this, that 2% through time. And the other wrinkle was he wants to be breaking inflation expectations, and he sees expectations remaining too strong. That's a really tough one to measure. I hope he sticks with the hard data rather than trying to divine people's expectations. Anyways, all in all, I thought it was good news for the home team. If you don't want to see interest rates going up any further, we certainly don't, because we think it's better for the economy. And it keeps that recession in 2024 soft. And again, kudos to Fitch for the downgrade, but it's not going to change anything happening on Main Street. It's mainly the liberal economists who are scratching their heads and wondering why they did what they did, because they don't get the debt angle. So thanks for listening to this FedWatch, and I will be seeing you next week. Take care.